If you're waiting for interest rates to drop in Canada significantly before making your next big move, you're going to have to wait a little longer. The Bank of Canada just made their highly anticipated July 2026 announcement, and they decided to hold their key policy rate steady at 2.25%. So you may be wondering, despite of everything going on, why have they decided to hold the rate yet again? Well, our economy is finally showing signs of life. But there is a massive tug-of-war going on between the roaring AI boom and volatile global conflicts. Let's break down exactly what is happening and what this means for your wallet. According to the bank, two massive global forces are battling out right now. On one hand, we have geopolitical instability. Ongoing conflict in the Middle East continues to drive up oil prices, which is putting upwards pressure on global inflation. But on the flip side, we are seeing a massive economic engine, and that is everyone's favorite, artificial intelligence. The Bank of Canada noted that the rapid build-out and investment in AI is boosting economic activity globally, particularly in the US, where strong consumption and investment actually push GDP growth by 2.5%. This creates a tricky balancing act. Global growth is projected to slow to 2.5% this year, before recovering to 3.25% in 2027 and 2028. But because of these global wildcards right now, the bank is once again playing it safe. Closer to home, Canada's economic journey has been choppy to say the least over the last couple of years. Between adjusting to new tariffs, high uncertainty, and slower population growth, economic growth essentially stalled, and the labor market softened. In fact, our unemployment rate is sitting at 6.5% in June, and it's basically hovered between there and 7% since 2024. But there is a light at the end of the tunnel. The Bank of Canada reports that economic growth resumed in the second quarter of 2026, bouncing back to an estimated 2.5%. Now, while some of that is just temporary factors simply unwinding, our economic growth is finally starting to broaden out. Overall, the bank expects that Canada's GDP will grow by just 0.7% in 2026, but then pick up to 1.8% in 2027 and 2028. Now let's talk about that big elephant in the room, which is of course inflation. In May, CPI inflation ticked up to 3.2%, largely because of higher gas prices, which of course is linked to the conflict in the Middle East. Here's the good news though. If you take gasoline prices out of the equation entirely, the inflation is actually sitting at 2.2%, which is right around that 2% sweet spot that the bank always strives for. While inflation is expected to be elevated within the short term, the bank projects that it will slowly ease and return to its 2% target in 2027. But again, there's a lot of uncertainty out there, so it all depends on what happens with those oil prices and other issues. So what's the bottom line? Well, the Governing Council thinks that holding the rate at 2.25% is the right move for keeping our economy on track without letting inflation flare up again. They are keeping a close eye on US policies, oil prices, and how the Canadian economy responds within the next few months. Mark your calendars because the next rate announcement is September 2nd, 2026. What do you think? Is holding the rate at 2.25% the best move for Canada right now? Or did you want to see a cut? Or do you want me to stop making videos about the Bank of Canada until they actually do something for a change? Let me know down in the comments below. Don't forget to hit the like button and subscribe, and I'll see you in the next video.